If you have ever thought about departing your home country due to high taxes, not being satisfied with the lifestyle, cost of living, or the political situation in your country, and that country happens to be Australia, then you might have encountered that there are many steps and considerations that you need to be aware of in order to become a tax non-resident in Australia. My name is Jelena. I'm a strategy manager here at Nomad Capitalist, and we help 7- and 8-figure entrepreneurs go where they truly best. When talking about rules that are applicable in regards to Australian tax on residents, there are again general rules applicable to the majority, and there are certain specific rules and consideration applicable on a case-to-case basis. Depending on what you have personally in Australia, your departure might be easier or more difficult and complex. As you are aware, each situation is different, and this is why these rules might apply a bit differently depending on your situation and circumstances, and there may also be some additional rules to take into consideration, which is why it's important to work with the right people. Here today, I will guide you through some of the general rules and requirements for tax non-residents in Australia. Now, if everything is in your personal name and you do not have a lot of unrealized capital gains, your departure might be smooth. But on the other hand, if you have companies, trusts, or super funds, especially a self-managed super fund, the process might be more complex and longer for you. When talking about personal departure and tax on residents, there are 4 tests in general that the ATO applies and looks at when determining your tax status. The primary test of tax residency is also known as the resides test, and it is the first one that will need to be assessed. And the remaining 3 tests then have to be considered, and these include the domicile test, the physical presence test, and the superannuation test. So the resides test includes that you must not maintain family, employment, or business ties and intend to make Australia your permanent home, and generally should cut ties to Australia to prove intent not to reside there. What this means is that you should limit your time in Australia as a tax non-resident and not have a place available to you in Australia. Your immediate family, meaning your spouse and your underage kids, should also preferably move out of Australia with you. The second test is a domicile test. So a person whose domicile is in Australia is deemed a resident of Australia unless the tax authority is satisfied that your permanent place of abode is outside of Australia. The way you can prove that you have a permanent intent to leave Australia and go somewhere else is if you can show that you have a place available to you elsewhere, either rented out or purchased, and you should cut as many ties with Australia as possible and establish them elsewhere. For example, bank accounts, credit cards, memberships to social clubs, gyms, or similar. The third test is the days test, or the physical presence test, which means that if you spend 183 days in Australia, you are automatically a tax resident. However, merely spending 182 days or fewer does not necessarily make you a non-resident. So the test applies in relation to the relevant income year rather than a calendar year. Your presence in Australia does not need to be continuous for these purposes. In other words, all the days you are present in Australia during the income year will be counted, so you need to be careful with that, and preferably should not spend this much time in Australia on a yearly basis. The fourth test is the super test, which is very simple. And it comes down to if you're an active participant in the super scheme, you are deemed to be a tax resident in Australia. It's simple as that. Now, to become a tax non-resident of Australia, you must demonstrate the intent to permanently leave Australia. Now, this does not mean that you can never return. You're free to change your mind later, but the intent at the time of departure needs to be of permanent nature. So it cannot be deemed as a vacation or a kind of a temporary exit. When you decide to leave Australia, one of the most important things to take into consideration is the exit tax. An Australian tax resident who is ceasing his tax residency is deemed to have disposed of assets that are non-taxable Australian assets or property at their fair market value on the date you become a tax non-resident. A choice is available, however, to defer the tax and pay the tax on the gain or profit when the asset is sold. If you choose to defer the tax and pay later, the tax will be assessed and paid at the highest non-resident tax rates when the investment is sold. You will also not be entitled to the full 50% capital gains tax discount for assets held for over 12 months. Thus, it is generally recommended to pay all the tax due while you are still a resident in Australia, especially if you expect your income to increase in the future. Now, if you're somebody who has a trust or multiple trusts in Canada, when departing Canada for tax purposes, you have 3 options when it comes to your Australian trust. The first one is to leave the trust in Australia with an Australian trustee. The second one is to take the assets out of the trust and close it down. And the third one is to leave the trust in Australia as a non-resident trust. Now, if you choose the first option, that is to leave Australia as a resident trust, generally, if an Australian resident is a trustee of your trust and you're departing Australia personally for tax purposes, you will not be obliged to pay the exit tax on the trust or its assets. However, the trust will continue to be taxed normally in Australia, and if you receive any income from it, you may be subject to certain withholding tax as a non-resident depending on the income. If you choose the other option, which is taking out or moving the assets, generally for the purpose of departing Australia, the trust works in the same way as a company. The only advantage of the discretionary trust is that the income is taxed in the beneficiaries' names at the end of the year. So the money can be taken out from the trust bank account without any issues because it has already been taxed. Any asset from the trust can be taken out without an issue as long as the market value has not changed. If the market value has changed, then you will probably have capital gains tax to pay. When the assets from the trust are sold, the profit is distributed among the beneficiaries, and it can be distributed in a tax-effective way, which would need to be planned with a tax expert. With a trust, there is flexibility in distributing the income and being taxed on it. If your trust has unrealized gains, upon taking them out of the trust, you will have capital gains tax to pay. Now, as a resident, you will get up to 50% discount on the capital gains for assets held for over 12 months. If you, however, choose the third option, which is to leave the trust in Australia as a non-resident trust, the most important part of a trust is the residency of the trust. As long as the residency of the trustees is Australia, then there are not any issues with it becoming a non-resident trust. If it were to become a non-resident trust, it would be taxed at the highest marginal rate. So the trust can be a non-resident trust in the case that there is nothing in it or it does not generate any income. Otherwise, we would recommend considering one of the other two options, as this is by far the least favorable one. Now, if you're somebody who has companies in Australia, when departing, you have two options regarding your company. The first one is to deregister your Australian company and close it down. And the second one is to keep the company active by appointing an Australian resident director upon your departure. If you choose to deregister the company, it generally takes at least 30 days from the date of the wind-up to process the deregistration form. If you choose to go this route, you should sell or transfer the investments and assets in your company prior to becoming a tax non-resident. And all profits and capital should be paid out by way of dividends, salary, or management fee, which will further be taxed accordingly. Alternatively, as mentioned, the company can remain active if you appoint an Australian resident director. However, all future profits will be taxed in Australia, so really there's no kind of tax benefit in doing so. If you're somebody who has a self-managed super fund, then becoming a tax non-resident will likely trigger a self-managed super fund to become a non-complying and will result in the highest marginal tax rate. For a self-managed super fund to receive a preferential tax treatment as a complying super fund, it must always be a resident super fund. If all members are overseas, then central management and control is considered to not be in Australia, and the SMSF is deemed to be a non-complying and can result in the taxation at the highest marginal tax rate. And yes, I know what some people who are familiar with the topic will say in the comments. There is an exception that states that the central management and control of a super is ordinarily in Australia at a time even if it's temporarily outside of Australia for a period of no more than 2 years. However, if you're permanently moving overseas, the absence will not be considered temporary and therefore you will fail at this test. Thus, it is recommended to either roll over your SMSF to a regular super or liquidate it. If you decide to roll over your SMSF to a regular fund, know that there is no tax on transferring the funds from a self-managed super fund to a regular one. However, if you decide to liquidate the SMSF before your departure, depending on what assets are in the fund, in general, the sale would be subject to the capital gains tax rules, and the SMSF will be entitled to a 1/3 discount on the total capital gain. The capital gain then will be taxed at the SMSF tax rate of 15%. Now, what we discussed today are some of the general rules, and there might be more underneath the surface depending on your particular situation, which is why you should definitely consult with an expert before doing something that involves a certain degree of complexity and risk. Obviously, there are many factors that need to be taken into consideration when determining your exit from Australia, and each situation is different, and there might be some things that can be applicable to your situation, like the rules for franked and unfranked dividends for non-residents, the small business concessions, or the process surrounding selling certain assets to your foreign company, which would have to be looked at separately for your particular situation. If you're considering becoming a tax non-resident in Australia, we'd generally love to help you. These were some important general rules that you should be aware of, and we can help you explore them in greater detail and see how they are applicable to your particular situation.